Just got a flurry of reports out today about the failures of both SVB and Signature Bank, which went down, remember, the same weekend about a month ago. It comes as the fate of First Republic is hanging in the balance. Let's get breaking news out of the FDIC on Signature Bank. Leslie Picker with the headlines. Leslie?
Yeah, Kelly, these reports really do feel timely. FDIC, as you mentioned, out with its post-mortem on Signature Bank, saying, quote, the root cause of the firm's failure was poor management. In a 63-page report, the FDIC says, quote, the bank could have been more measured in its growth, implemented appropriate risk management practices, and been more responsive to the FDIC's supervisory concerns. And the FDIC could have been more forward-looking and forceful in its supervision. FDIC says Signature Bank was overly exposed to a concentrated group and large group of uninsured deposits, and that management did not appropriately manage liquidity risk amid high growth. Notably, the FDIC said Signature's management was not responsive enough to their supervisory concerns. They took some of the blame, but noted that the agency had resource challenges, not able to staff an examination team to appropriately monitor the bank. That was particularly the case in New York, where there's greater competition from the private sector for jobs and a high cost of living, which made it difficult to attract staff, in addition to the pandemic, which made it hard for them to bring appropriate examiners here. Now, the report did stop shy of issuing regulatory recommendations here, as Chief Risk Officer Marshall Gentry said on a media call that the purpose was meant instead to pinpoint the root cause of Signature's failure. Now, Signature was the third largest bank failure in U.S. history, with an estimated cost to the FDIC insurance fund of $2.5 billion. Kelly.
You know, to say we didn't have enough people is a pretty interesting way of evaluating this, Leslie. Did they say anything about crypto specifically?
Crypto in the report was mentioned, of course, as being kind of something that they should have been more aware of. Obviously contributed to the just massive growth that they saw. And then the FDIC says that they weren't equipped to keep up essentially with that growth. It's something that we also heard from the Fed with regard to SVB, just this idea that these firms were very fast growing. Regulators are, I guess, used to slower, sleepier firms to regulate. And so kind of the nature of their clientele, the nature of their customer base, and then, of course, in a low interest rate environment where things were go, they just weren't set up to handle that, especially in a resource challenge, a labor challenge environment.
Fascinating. Thank you, Leslie. Leslie Picker.